Hello and welcome. This is Professor Svark. I'm going to walk you through some selected material in Chapter 2. I do want to remind you that these are ACC Sessions, which stands for Access Course Content, or of course, accounting. And this video really is selected topic only. So you do need to read through the chapter, take notes for all the material in the chapter, learn your vocabulary from the chapter, conceptual material from the chapter, as well as financial ratios. If you have any questions or you are struggling through any of the content, make sure that you seek help either from myself or the tutoring center. Make sure that you complete all the coursework, because remember, this is learning a new language which requires a lot of practice. And once you complete the coursework, it doesn't stop there. You want to make sure that you are quizzing yourself through the material. So take flashcards or Cliff Notes or whatever your method is. You can do online quizzes at Quizlet.com or other resources. I'm sure your phone has something if you've got a smartphone. But make sure that you are quizzing yourself or using recall to learn the material. And this chapter is a really important chapter. This is the building blocks for the rest of the course. So if you mess up with this, with the T accounts and the journal entries, you will struggle through the rest of the material. So if you do nothing else, make sure that you're paying extra special attention this week. We are going to go through accounting equation, which is a review from the last chapter. We'll talk about T accounts and the rules for T accounts. So remember, this is a language. So we've learned some vocabulary. We're going to learn a little bit more, and now we're kind of putting the grammar together, right? The rules. And then we're also going to learn journal entries and financial statements. So if you remember from last week, we learned the accounting equation, which is assets equals liabilities plus owner's equity. It's a nice acronym here, ALLO. And of course, owners is in parentheses because of the fact that it doesn't appear in your textbook. So I put it in there just so that we have the acronym to help you remember. Assets equal liabilities plus owner's equity. And there are 4 pieces to equity, if you recall: common stock, revenues, expenses, and dividends. So the acronym for this is C-RED, because accountants never want to see red. If you see there's common stock plus revenues minus expenses minus dividends. So remember that ED is the piece that subtracts from equity. So on the right side of the equal sign, liabilities and equity, all of that increases except for ED. Okay. And then of course we went through what is an asset. Okay, an asset is something that the company owns or controls. Remember that when we are talking accounting, we are talking about companies, not the owner's assets or not the owner's money or not the owner's transactions, but it's specifically what does the company own. Now, a company can own or control things just like we can. The company can have cash, supplies, equipment, vehicles, land, and building. Those are things that we have too. But then they also have accounts receivable, which is an account that we keep track. It's kind of a database that keeps track of what is owed to us. What are we going to receive in the future? And then this chapter introduces us to prepaid expenses. So a prepaid expense is something that we are paying in advance. Okay, one of the biggest prepaid expenses is insurance. So oftentimes we pay an insurance policy 6 months in advance or a year in advance. And when we do that, it's an asset to us. It's something that we control, right? Because we could cancel that policy and get our money back. Or we could increase it or decrease it. It's something that we own. Now, as we use it, okay, as we incur that insurance, we will move it to an expense. And we will see that in Chapter 3. Okay, liabilities, it's on the opposite side of the equal sign, and it's kind of the opposite of an asset. So this is something owed by the company. So whether that's cash or services owed. There's accounts payable, wages payable, notes payable. And again, the difference between an account and a note at this point, just think of it as a note is a formal signed document. And then Chapter 2 introduces you to unearned revenues. Unearned revenues are money collected in advance. Okay, so similar to prepaid expenses, but we're collecting the money in advance and we've not yet earned it. Remember that the revenue recognition principle tells us that until we've actually provided the service, we cannot record the revenue. So if we collect cash, we need to record that in our accounting transactions as cash in, but now it's a liability. We owe services in the future. Okay, so students often confuse, I lost my arrows, but students often confuse accounts receivable and accounts payable. So again, just like I told you in the Chapter 1 material, ask yourself what's going to happen in the future. If we're going to receive cash in the future, it's an accounts receivable. If the company has to pay cash in the future, it's a payable. Okay, and then of course, equity. Common stock is just an account that tracks the investments in the company, whether those are cash investments or asset investments such as equipment that was contributed by an owner. Okay, so common stock, it tracks the amount of investments. Revenues tracks the fees charged to customers for services or sales. Things like consulting revenue, fees earned, rent revenue, sales. Okay. Expenses is an account that tracks the costs of the business. Now these again are costs that have been incurred. Okay, so wages, rent, supplies, and again supplies expense means it's been used up. Advertising, utilities, okay, lots of other types of expenses, just like you or I, we may have certain expenses in our lives. Companies are going to have similar types of expenses. Okay, and dividends tracks payments to investors. Okay, so it's a special account. The only thing that's going to go in a dividend account is when we pay our investors. Okay. So again, this is the same material from Chapter 1. What's the difference between supplies, which is an asset, and supplies, which is an expense? It's that it's been used. When it's an asset, it's basically sitting there in the supply cabinet waiting to be used. When we use it, it becomes an expense. Okay, so this is from your printout that you should have been able to download from Blackboard. Identify each of the following as either an asset, a liability, or an equity. Okay, so cash dividend, remember that's part of ed, the D in the dividend, it's part of ed, so it's equity. Office equipment. Equipment is something that's owned by the company and controlled by the company. It's an asset. Accounts payable. This is a hard one for most students, so again, think about what it is. Accounts payable is something that we have to pay in the future. It's kind of like a credit card. So it's a liability, something that we owe. Cash. Cash is the best form of an asset. Okay. Utilities expense. Remember that expenses are part of ed, equity. Office supplies. This is a tricky one also because often you and I think about just going to the Office Max and buying, a ream of paper or some pens because we need them from class. But companies buy in bulk. So office supplies sit in a supply room or a supply cabinet and they are an asset. Okay. Prepaid rent. Ooh, this is a new one. Prepaid rent is when we prepay for our rent. Okay, so maybe we pay 6 months in advance for our rent. Okay, so somebody owes us, right? Somebody owes us that rent or that use of the space that we're renting for the next 6 months. We own and control that 6 months deposit. Theoretically, we could cancel it, okay, and get out of it and get our money back. In reality, there's probably a contract that says we can't, but theoretically we could. It's an asset. Unearned fees. Again, this is the other new account we learned. And remember that unearned fees are when somebody gives us money. Okay, so now we owe services or their cash back. It's a liability. I would recommend that you practice heavily this prepaid and unearned. Okay, and then service fees earned. Okay, fees earned are revenues. So that's part of equity. Okay. This is a good flashcard opportunity to run through these. Make sure that you have these types of things learned. There's several different things that revenues can be called, which is revenues, fees, earned. We're going to learn in a couple chapters, sales could be a revenue account. All right, so let's build on this knowledge. Now that we know our accounting equation, we understand what types of accounts go under each part of the equation, let's figure out how we actually do the accounting. Okay, so this is a T account. You notice that it looks like a T. It is a tool that accountants use. So I've seen accountants that have 30 years experience get out a scratched piece of paper and use a T account as a tool. They're very, very widely used. However, they are not a formal accounting transaction. Okay. So the rules of a T account is that it always has a title. For example, if you were going to analyze a cash account, you would write the title cash on top. The left side is always a debit, and sometimes it's shortened with a DR. Okay, that comes from Latin DR, the DR abbreviation. The right side is always the credit, or CR. Okay, so these are the rules that, again, good flashcard opportunity. Debit's always on the left, credit's always on the right. So now let's go ahead and take cash. We're going to analyze cash. And I've got 4 transactions here. Invest cash in the company, purchase equipment with cash, pay advertising with cash, and collect cash fees with collect cash for fees. Okay, so we're going to analyze just what happens in cash. Now, every time you analyze a transaction, it will affect at least 2, sometimes more than 2 accounts. So you always, to keep the accounting equation in balance, you always want to affect at least 2 accounts, but we're just going to isolate things and look at cash here. So remember that debit's always on the left, credit's on the right, but the thing about accounting is that the rules for debits and credits change. So for cash or any assets, a debit would indicate an increase and a credit would indicate a decrease. Okay, so for assets like cash, debits are increases, credits are decreases. Okay, which may feel a little different than when you use your debit card. When you use your debit card, it's the opposite, but I'll explain why kind of at the end of this lesson. Okay, right now you just need to remember that I'm teaching you new rules. These are accounting rules. You have to kind of get rid of the terminology that you've been taught about just in life, like anything that you've associated with debits and credits. Get rid of that, push that out of your mind, and think debit on the left, credit on the right. For assets, debit means increase, credit means decrease. So let's analyze these 4 transactions. If you invest $500 in the company, okay, now the company's cash will go up. Now this is a common error that students make. They want to analyze the owner's cash. Owner's cash goes down, but we don't care what happens to the owner. What we care about is the company. Company's cash goes up. So therefore we would record that with a debit because in cash, a debit means increase. Okay, number 2 says we purchase equipment for $100 cash. So what happens to cash here? Did cash go up or down? If we purchase equipment, that means we have to pay cash. So cash would go down. We would record that with a credit. 3 says we pay advertising with $50 cash. Okay, ask yourself what happened in cash. Did it go up or down? Well, in this case, we paid cash, so cash goes down. Again, that's a credit because for cash, credit means decrease. And finally, in 4, we collect $200 for consulting fees. Okay, what happened to cash? Cash goes up if we collect cash. That means we want to increase cash with a debit. Okay. So this is what you do when you analyze an account using a T account. Now the last step here is to balance the T account. So at any time when you're looking at a T account, you can determine the balance by adding up the debits, adding up the credits. Okay, so you add the 2 different columns, you get subtotals. So there's $700 in debits, $150 in credits. Okay, so add up both sides. You take the difference between the 2, and the difference falls on the heavier side. Okay, so those are the rules for T accounts. To balance a T account, you add up both sides. The difference between the 2 is the balance, and the balance will always fall on the heavier side. So here we have a $550 debit balance. All right, so that was a lot, but now I'm going to kind of even increase the complexity here. because I've just taught you that for cash, debits mean increase, credits mean decrease. Okay, and that is the same rule of thumb for all assets. Okay, for any asset, a debit would indicate an increase, a credit would mean a decrease. But when you get on the other side of the equal sign, when you go into liabilities, it's the opposite. In a liability, you have a credit is your increase, a debit is your decrease. Okay. Common stock and revenues go along with that same philosophy. So on the right side of the equal sign, you've got credits mean increases. Okay, except for ed. Remember that ed's our troublemaker. Ed decreases our equity. So ed goes back to the same rules as an asset. Debits are increases, credits are decreases. Now you may want to stop and review this, or stop and make some cliff notes for yourself and quiz yourself at this point, because it's really important to remember which side increases and which side decreases. And students always want to make sense of this, and I would encourage you at this point, don't make sense of it. I'm going to teach you this is a whole database that works together. Accounting always balances. There is a systematic process to it, but sometimes it feels a little overwhelming at this point. Right now, I need you to understand what are the accounts that go under each part of the equation and how do they increase and decrease. Okay, once you've got that, let's go ahead and, well, we'll stop after this point, but after you've got this piece, then we can go ahead and start analyzing transactions. Right now, I'm going to have you analyze the normal balance, debit or credit, for each of the following accounts. This is part 2 of your handout. And I just want to go back and talk about the normal balance. So a normal balance is always a side that increases. And let me explain why. If we go back to the T account here that we analyzed cash, the normal balance for cash is a debit. Let's talk about what would happen if it was a credit. Let's say that we had a $1,000 payment. Okay? If we had a $1,000 payment, that would show in the credit side. That would mean that we took our cash into the negative. We bounced a check. Okay? So we never want to see a credit balance in cash. That means we're negative. So the balance is always on the side that increases. And if you see an abnormal balance, a balance on the side that decreases, you know there's a problem. Okay? So thinking back, cash dividend. Cash dividend, remember that dividend's part of ed. So ed has the same rules as cash or assets. So they increase on the left or the debit side. Okay? So ed increases with a debit. That means that a debit is a normal balance. Okay? Office equipment. Office equipment is an asset, something that's owned or controlled. That means it increases with a debit. The normal balance is a debit. Accounts payable. First step you got to know is that there's a liability. I have to pay it in the future. Liabilities increase the opposite of assets. They increase on the right or a credit. So a normal balance is on the credit side. Cash, hopefully you're starting to get the hang of this. Cash increases on the left. The normal balance is a debit. Utilities expense. Remember that that's part of ed. Utilities expense is part of ed expense. Expenses increase just the same as a asset or as cash. So expenses in equity, it increases with a debit. Office supplies. Remember that supplies is an asset. Supplies increases with a debit. Okay. Prepaid rent. Remember I told you this one would be tricky. Prepaid rent is when I prepay something in advance or the company prepays it in advance. We control that in theory. Okay, so it's an asset. It increases with a debit. Unearned fees. Another tricky one. This is when we collect cash in advance, which means we owe, right? It's a liability. It's the opposite of an asset. It increases with a credit. Fees earned. Fees earned is part of equity. It's not part of ed though, so that means that it increases with a credit. Okay. So again, another good point to stop, quiz yourself, even print out a second one. So we've just done this exercise. Maybe take a 5-minute break, print out a fresh sheet, and quiz yourself. See if you can do it. And if you can't, stop and practice. Create some flashcards, practice this until you get the normal balances. It will make the next step easier. All right, so now do you remember those 9 transactions from last week? We're going to go ahead and look at those 9 transactions, and we're going to analyze those. Instead of just increases and decreases, now we're going to take a step further and analyze it with debits or credits. So step 1 was to invest $2,500 into a delivery business. Okay, remember you're always looking for 2 parts to the transaction. Okay, the first one that I would think of would be cash. What happened to cash? Cash increased. If cash increased, let's look at the cash part here. Oh, increases are with a debit. So we would show a $2,500 debit to cash. Now what's the other side of that? Try not to be so overwhelmed. Deep breath. Think about just reading number 1. Invest $2,500 into a delivery business. Remember that investments are tracked in the common stock account. Okay, so common stock also increased because this is a database just tracking how many investments we've had. So common stock increases with a credit, $2,500 credit. Okay, now we've got $2,500 on both sides of the accounting equation, and we have equal debits to equal credits. Every time you analyze a transaction, you have to have equal debits to equal credits. And we've got 1 debit of $2,500, 1 credit of $2,500. Number 2, we purchased a $10,500 delivery van with $500 down and by signing a note for the difference. Often students get a little overwhelmed here, so I always say, what happened to cash? We paid $500 down, right? So cash decreased by $500. Okay, we can get that part. We've got one piece of it. Now analyze the next part. We purchased a van. Okay, remember that vehicles are assets. They're something that the company owns and controls. So vehicles went up. Under an asset, we know that vehicles or increases in assets are shown with a debit. Okay, so now we have a $500 credit, a $10,500 debit. We still need another credit. Okay. The last piece of this is we signed a note payable. So note payables increase. Now note payables are liabilities. They're like accounts payable, but remember they're formal, they're signed. And I don't have a notes payable here, but it's okay. I'm not going to panic. I'm going to add one. Okay, notes payable is just like an accounts payable. Okay, we signed a note for the difference, so that would be a credit, an increase to notes payable of $10,000. Now here's another tricky part, is payables. What we're doing is tracking the balance owed. Okay, so even though you may associate like credit cards or amounts owed as a negative, and so sometimes students want to put that on the negative side. But what we're doing is we're tracking the balance. The balance went up. So if the balance went up, we want to put it on the plus side, the credit side. All right, 3, we purchased $7,500 on cash. $75 of supplies on account. Okay, nothing happened to cash here, so that's not going to help us. We see the word supply, so we know that $75 is supplies. Okay, if we've been practicing our flashcards, we know that supplies is an asset. Okay, so supplies went up by $75 and assets increased with a debit. Okay, so we could mark that as $75 increase debit to supplies. The other side of that says on account. So now students sometimes get this confused. Accounts receivable or accounts payable? Well, what do you have to do? If you went to the store and bought something on account, paid for it with your credit card, you'd have to pay for it, right? So accounts payable. Accounts payable goes up, and again, you want to show that as an increase to the balance. Okay, and here we have equal debits, $75 debit to supplies, $75 credit to liabilities to accounts payable. All right, number 4, we purchased $250 in advertising and we pay cash. Phew, cash here. Cash, if we pay it, that means cash went down. Okay, so credit to cash. And what's the other side of that? Advertising is a cost, right? It's an expense. So now we're going to go over to Ed. Here again, you have to think of this as a database. Here we are tracking the expenses in the company. So expenses are increasing. We're going to record an expense, the addition of an expense to the left side or the debit side. Expenses are always debited. Okay, that's another kind of rule of thumb. Expenses are always debited. Now I'm going through this rather quickly, and it might be taking you a little more time to think through these transactions, and that's normal. You're going to need some practice, just like if we were learning a new language like Spanish or French. So just keep on going, keep on listening. If you need to re-listen, or if you need to stop and practice those flashcards, stop and practice. But realize this will come easier and easier, but you need to make sure that you understand each piece before we move on. Okay, number 5 says we make 2 deliveries and collect $100 cash for each delivery. All right, we know cash went up here. Okay, $200 cash went up. I look at my cash column, increases a debit. Okay, what's the other side of that? If I perform a service, I perform a delivery, that is a revenue. If I look at my revenues there to the right, revenues increase with a credit. Okay. Equal debits, $200 cash debit, $200 credit to revenue. Number 6 says we make 3 deliveries for $100 and send the customers a bill. All right, so no cash, right? If we just send the customer a bill, there's no cash collected. I know that I'm recording revenue here. Even though I don't get the money, the revenue recognition principle says that once you perform the service or make the sale, you record the revenue. Okay, so I can increase my revenues. If I look at the revenue column, I know that that's a credit. What's the other side to that? Okay, remember there's that account called accounts receivable. So accounts receivable is where we track our future cash coming in, future cash being received. Okay, so accounts receivable goes up. So I'm going to track that receivable from that customer in my accounts receivable balance. Okay, again, equal debits to credits. $300 debit to accounts receivable, $300 credit to revenues. All right, number 7 says we make $50 payment for transaction 3, and transaction 3 was to purchase supplies on account. Okay, analyze cash first. Cash is going down, right? So that's an easy enough one to do. Credit to cash. Okay, but what's the other side of that? I will tell you that most students want to hit supplies, but we've already recorded the supplies. All we're doing is making a payment. Okay, just like if you went to the mall and bought a pair of jeans on your credit card, when you make the payment, you don't get more jeans, right? All that happens is your credit card balance goes down. So that's what we're going to do here. We're going to go to our, quote, credit card, accounts payable, unquote, because it's really not a credit card, but it acts like one. So we're going to go ahead and show a decrease to accounts payable. This is the database that tracks the amount we owe. Okay, so we're going to show a decrease to that balance. Okay, number 8, we collect $200 from customers in transaction 6. And remember, transaction 6 was those 3 deliveries. Okay, so analyze cash first, because sometimes this gets really overwhelming. So think about cash. Cash went up, right? I collect money. Okay, I got half my transaction. I've got a debit. Now I know I need a credit. Okay, again, this is the same as 7, as students often confuse this transaction. They want to record revenue, but we already recorded revenue. Up here in revenues, we already hit this. It was $300 here. All we're doing now is showing that our customer paid us money. So we're going to go over to accounts receivable, and we want to decrease the balance in accounts receivable, indicating that the customer paid us. Okay. They didn't pay us the whole amount. They only paid us $200. So if we balance the accounts receivable account, we can see that there's a $100 debit balance remaining. But we want to show that they paid off the $200 of the $300. Okay, last one, pay $90 in dividends. What happens to cash? Cash decreases. What happens to dividends? We need to go ahead and record an increase to dividends, because remember, this is a database tracking the amount of dividends we pay out. So dividends gets increased with a $50 debit balance. Okay, and then the next step is to go and balance each account. Remember that balancing the accounts means you add up the left, add up the right, take the difference falls on the heavier side. So here you can see that accounts receivable balance of $100, revenues has a $500 credit balance. Okay, everything else, accounts payable, we still have a little owed. We have a $25 credit balance. It's a normal balance because it's on the side that increases. Okay, we've got all of our balances here. From here, we could create financial statements just like we did in Chapter 1. Okay, we would take revenues of $500 minus expenses of $250 to get net income of $250. We would take beginning equity, which is 0, okay, plus net income of $250 minus dividends of $50 to get ending owner's equity of $200. Okay, and then we could plug in our assets and our liabilities, our common stock and our equity into the balance sheet to get our totals there, our assets that equal liabilities plus equity. We'll go through those financial statements at the end here, but I just want to make you aware that you do need to know those financial statements. So you should have been practicing those from Chapter 1 on your flashcards or whatever method you're using. You should know those off the top of your head. And if you don't, you need to make sure that you invest a little time this week into learning those. All right. So analyzing transactions, this is the way it works. However, it's not the end here. The next thing that we need to learn about is general journals. Remember that I told you T accounts are just a tool. T accounts are a tool to analyze the transactions, but they are not the formal entry. Journal entries are the formal entries. So we're going to record this on what's called a general journal. And you can see that it kind of looks like a notebook, piece of notebook paper, right? There's some columns in it. There's a date column. There's this PR, which is called a posting reference column. And then you've got a debit and a credit column. Okay, so now we're going to take and just create a journal entry. Okay, here I recorded the date. I just picked a date, July 1st. And the first entry was to record the owner investment of cash into the company. So we take our debit account first. So here we record the account. The cash account increased with a $2,500 debit. The second part to this was we increased common stock with a credit. So you can see here the debit comes first, the credit comes second. The credit is indented slightly. And then our amounts go in the debit and credit columns. So date, account name, with the credit indented, debit amount, credit amount. We're going to ignore the posting reference column for now. Basically the posting reference is for when you actually go to the next step, which is posting. Okay. And the posting reference is more of a clerical thing just to show, yes, these are posted. So if the next person would know what stage of this accounting cycle that you're in. Okay, and we could do these for each of the transactions. The third part of a journal entry is just to write a little description. So there's no right way to write a description. You want to just say, you know, what is this transaction about? The owner invests cash in the company. For this class, we're going to omit the little reference column. Okay, so we're just going to focus on debits and credits. So the second entry was we purchased a vehicle. Remember, we purchased the vehicle with $500 down, sign a note for $10,000. The vehicle cost a total of $10,500. Okay, so we're going to record debit to the vehicle account. We're going to put the debit amount in the debit column. We're going to credit cash. That goes in the credit column, and we're going to credit notes payable, which is in the credit column. Okay, so all I'm doing is I'm taking those T accounts we just made and I'm putting them into a formal journal entry. Okay, date, account name. This is the debit that we did. We debited the vehicle account. We credited cash and notes payable. Cash was for $500. Notes payable was for $10,000. Okay, if we had account numbers, which we don't, we would write these account numbers in when we post the journal entries. Okay, the next one was we purchased supplies on account. So you write the debit first. The debit was to supplies for $75. Remember what the credit was? It was on account. So it was accounts payable. So we're going to pay it in the future. That would be a credit of $75. Okay, so you will hopefully get to the point where you don't need the T accounts. You can go right from the description of the accounting transaction right to the journal entry, but it's going to take some practice. So you need to make sure that you get those increases and decreases down. Okay. So let's go to your handout. I believe this is part 3. Let's prepare journal entries for each of the following selected transactions. The first one was on January 13th. Deshaun Tyler opens a landscaping business called Elegant Lawns by investing $7,000 cash, equipment having a $3,000 value in exchange for common stock. Okay, so 3 accounts here: cash, equipment, and common stock. Now what I would recommend that you do is kind of get your own Cliff Notes going here and use these for a reference for a while. Okay, if you have to, go ahead and record the increases and decreases down here on your T accounts, but after a while you might just have to have a little sheet of paper that shows your T accounts. And at the exam, I need you to have this down in your head. It doesn't mean that you can't write the you cannot bring this to the exam, but once you're in the exam and you sat down, you're ready to take the exam, you can take what's in your memory, okay, what's in your brain, and put it down on a piece of paper. So you could bring this tool in your brain and write it down to help you analyze transactions. Okay, so cash. Cash is an asset. Assets increase with a debit. Okay, oops, sorry, I meant to tell you, remember that we circle Ed, and Ed has the same rules as assets. Okay. So the date is January 13th. Cash is our increase. Cash is our debit. Okay, so 7,000. We also have the equipment. Equipment is also an asset, so it also increases with a debit. Okay, the other side of that is common stock. So if we go over to equity, common stock increases with a credit. So we would credit common stock, and we would give the owner common stock for the total of 10,000. Okay, sometimes students don't know what to do here. They want to credit 7,000 or credit 3,000. Okay, but if you invest in a company, let's say your best friend wants to open a company and says, let's open a company, can you give me your computer and $1,000 cash? Okay, you're not going to just give your computer up for the sake of giving it up. You're going to want a share of the company worth the value of the computer. And this is what's happening here. The owner's giving some cash, some equipment, they're getting common stock, they're getting ownership into the company of the value of both those items. Okay. On January 15th, Elegant Lawns pays $1,200 cash for an insurance policy covering the next 12 months. Okay. If you're confused here, if you're feeling a little overwhelmed, ask yourself what happened to cash. Okay, cash decrease, that's a credit. Okay, so we know we can start with the credit here. We're going to leave room for the debit. We can start with the credit. We're going to go ahead and credit the account for the $1,200. Now the trick is, let's put in the debit, because we need equal debits and credits. What is that? When we prepay an insurance policy, okay, that's a prepaid expense. Remember, that's an asset. So prepaid insurance is an asset, and our asset account is increasing by $1,200. Okay, the next one, on January 21st, Elegant Lawns purchases office supplies on credit for $250. Okay, so nothing happened to cash because we basically used credit for this, right? Okay, but we know that supplies comes in a storage container, right? It's a supply room or a supply cabinet because it's an asset. Companies buy in bulk. So supplies is going up, assets increase with a debit. What's the other side of that? Well, whenever we buy something on account, it's either accounts receivable or accounts payable. So ask yourself, what's the future action? We're going to pay for it, right? So that's accounts payable. Accounts payable is increasing with a credit. And even if you're stuck here, let's say that you can at least get the fact that it's accounts payable, but you don't know if it's a debit or credit. We have enough information here to get us the rest of the way. We have to have equal debits to equal credits. So we know that accounts payable must be credited. Okay. Next one, January 29th, Elegant Lawns receives $750 cash for performing landscaping services. All right, we know what's going on with cash. Cash is increasing. Our company's getting cash in hand. Cash is an asset. Cash is increased with a debit. I always tell students, in this class, about 80% of transactions involve cash. So if you know the direction of cash, you got at least half the transaction right. Okay, and now we can solve for the rest of the transaction, right? Because we know that what we're lacking here is a credit. We need to have equal debits for equal credits. So the next step here would be to credit something. What are we going to credit? We performed a service. If we perform a service, that's a revenue, right? I don't know what that revenue is called. I'm going to take a leap and say it's landscaping fees. Okay? It doesn't matter. You can say landscaping revenues as long as you understand that revenues and fees or fees earned are the same. That's where we're going with this. So equal debits, equal credits. Okay, January 30th, Elegant Lawns receives $800 cash in advance for performing landscaping services to a customer. Okay, again, what happened to cash? Cash increased. Cash is an asset. Assets increase with a debit. So we've got half of our transaction. We're going to debit cash. What's the other side of that? If we get cash in advance. Okay, we didn't actually do anything yet for that. So we owe our services. If we owe our services, that's a liability. Okay, that's unearned fees or unearned revenues. We owe our services. Okay, January 31st, Elegant Lawns pays cash to settle the payable for the supplies purchased in transaction C. Okay, this is a payment of cash, so we know that cash is going to be our credit, but what's our debit? Remember that I told you this is one of the hardest transactions for students to get. If we pay off something owed, we don't get to record a debit to supplies, and most students want to. Okay, we already bought the supplies long ago. Now all we're doing is kind of paying off our credit card, right? It's not a credit card, but it's like paying off our credit card. So we need to hit the transaction that's going to reduce that amount. It's accounts payable. So we're going to reduce our liabilities. Here's where we're going to debit and reduce the amount owed. All right, from here, we would want to go ahead and prepare financial statements. And remember that financial statements, this is my Cliff Note version, income statement, revenues minus expenses equals net income. Statement of retained earnings, we would take beginning retained earnings plus the net income minus the dividends equals the ending retained earnings. And finally, the balance sheet is assets equals liabilities plus equity, but remember that equity is common stock and ending retained earnings. So each of these statements flows to the next. So net income from the income statement goes into retained earnings, and ending retained earnings from the statement of retained earnings goes into the balance sheet. All right. Now, one thing I want to say about this, let me go back to the T accounts. Okay. So here's the T accounts. In this chapter, you're going to learn that posting, so after you do your general journal, the journal is where we record all the transactions, so it hits lots of different accounts. Okay. After you have all those different accounts, it's not easy to look at a journal paper and see what the balance is in cash. So it's necessary at that point to post your transaction. So you would go through every single transaction and now post. In this chapter, you learn that you can post to T accounts. So we went out of order here. At the end of chapter 2, or chapter 3 at the maximum, I want you to be able to look at a transaction and go right to a journal entry. And from a journal entry, then you would go back to a T account and post the transactions. Okay, so that would give you would take your journal entry from your general journal, which has all sorts of different accounts on it, and now you would go back and post to the specific accounts so that you could get account balances. And from there, you could create a trial balance. And a trial balance just lists out all the different accounts and each balance. Okay, and from the trial balance is where we prepare financial statements. Okay. Oops. I went too fast there. Okay, so from there, then, we could go ahead and create financial statements for each balance. And each balance, again, only appears on the financial statements one time. So we would go ahead and record revenues of, what were they? I think 500 when we were looking at our example. And expenses were 250, so net income was 250. Beginning retained earnings was 0 because it's a brand new company, so there are no retained earnings. Remember that retained earnings are the earnings that have been retained in the company since inception, plus our net income of $250 minus dividends of $50 would give us ending retained earnings of $200, and then we would plug in assets, liabilities, and equity. All right, let me just go to this, make sure that we've hit all. So here's your printout that you should have been following along, and I think I've hit everything on here. In Chapter 3, we're going to build on this. So you need to make sure you know your journal entries down really well, and your increases and decreases, and how each part increases and decreases. Okay, you need to be very comfortable with this. I always tell students, go ahead and redo these sheets without looking at anything and see where you're at. Kind of test yourself. And create either flashcards or cliff notes that say, you know, what happens when you, let's say for example, we pay $1,200 cash for insurance policy covering the next 12 months. Okay, if you flipped over your flashcard, it might say increase the cash, increase the cash debit, increase to prepaid insurance. I'm sorry, whoop, I went wrong there. Decrease to cash credit, increase to prepaid insurance debit. B, if you purchase supplies on account, that would be supplies, increase debit, accounts payable, increase credit. Okay, so practice these transactions, because the more comfortable you are with each transaction, the easier it's going to be to build. And Chapter 3 is going to build, and it's a pretty difficult chapter for most students. All right, so on that, I'm going to say goodbye. Again, practice, practice, practice. Once you've gone through all the homework assignments, create flashcards and just practice. All right, have a wonderful day.